as is our custom, we will try and start off with these simple questions. So question 3 looks like in this instance it was 20 marks. And okay, we're gonna check when this question paper was. But we're only gonna deal with these 12 marks here, the simpler questions, since we're only starting the module now and we just wanna put these ones away. All right, so it's true or false. True or false. So 12 marks is quite substantial, so it's not something that we can just let slide. Okay, so I think we can have a discussion on this. So you can unmute yourself. I want to hear what you think about these questions. So just try and imagine. Just try and imagine. No, this is too big now, but it's fine. The bigger, the better. Right. State whether each of the following statements is true or false. Money serves as a medium of exchange only in the form of currency and not in the form of checks. Is it true or false? Sorry? I missed that one a little bit. Let me just cut this person here.
All right.
Sorry, yeah. So, yes. Is it true or false? So we are saying, I hear someone talking, it's not clear enough. Money serves as a medium of exchange. So medium of exchange, we're basically talking about using it to buy. So is it the case only in when it's in the form of currency and not in the form of checks? True or false?
It's false.
False. I agree there. Because we normally write each other checks, or we used to write each other checks some time back. All right.
Yeah.
Mark. And then money can be used interchangeable with income, but not wealth. True or false?
It's also false.
Also false, right? You can't use it interchangeable with income. Why so? Because money is a stock variable. Income is a flow, like your salary. It's your income, it's a flow variable. But you know the way people talk, people normally treat these things as same thing. Yeah? When you talk of my money, he always may be referring to income. You see, maybe with wealth, but then again, in terms of economics or this module, wealth does consist of your money, right? But it's not all there is. There is much more to it. But when you talk of money as a unit of account now, your wealth is gonna be measured in terms of it must have a monetary value. But again, wealth and money is not the same thing. Again, money and income is not exactly the same thing. So, all right. So I agree on that one. Where the payment system is heading could influence the way money will be defined in future. Do you agree?
Sorry, I joined it late. Which question paper are we doing?
So say, oh no, I just picked a question paper from, I believe it's I don't know, maybe last semester's question paper. But what we basically do, we are just picking questions, these type of questions here.
Oh, okay. Thank you.
And now that you are still on mute, okay. I was going to ask you to answer this one, but let me give you a break. Okay. Where the payment systems is heading could influence the way in which money is defined in the future. What do you think about that? True or false?
I'll go with this one.
You'll go with what?
True.
I agree with you there also. I also go with true here. Because in terms of, I think why I would agree with you on that, it's because the way, if you look at money, for instance, when you talk of our definition of money, I think last time we were referring to M1, M2, M3, etc. So the more these things evolve, it could, when we talk of the definition, we can be referring to what can be included in the definition of money and what's not included in the definition of money. So when these payment systems are being evolved, then there could be a change. It could obviously influence the way money is being defined. If you start talking of, for instance, checks and the likes, you see, maybe at some point a check wouldn't have been included as money. Now people have got, debit cards and what have you. So it's got some high degree of influence on the definition of money. So I think I agree with you there. Right. And then money has been different things at different times, but it has always been important to people in the economy. Has it? True or false?
True.
It's true.
True. We agree on that one, right? At the end of the day, it's important. Money, if you want to kill an economy, play around with the monetary sector. Right? Just play around with the monetary sector, and then you know. So in other words, if you mess up at the Reserve Bank, then you are simply messing up the whole economy. So which is why when bigger countries take advantage of smaller countries, they want to own the central banks, and they basically want to control whoever controls the central bank. I don't know if you guys have heard the saying about robbery. I can't remember what it was about, but the last part of it was, if you want to rob a nation, just steal the bank, just steal the banking system. So once you steal the banking system, then you have robbed a nation. You have basically stolen from the nation. So if you want to be a robber, if you want to be a thief, don't steal the money in the bank. You will use it. It's gonna finish. But if you steal the banking system and you run the banking system, then you get to decide the laws that work, right, in terms of the monetary laws. Think about the person who, I'm sure you know that the United States dollar is owned by individuals, right? If you look at the South African Reserve Bank, for instance, you ask yourself the question, who owns this bank? Because it's not government owned. So whoever owns it is responsible for the printing of money, is responsible for the laws that regulate the banks. Have you ever wondered how much a bank charges you just for an e-wallet? You see? So, all right. Financial intermediaries are not an important part of financial structure. True or false?
False.
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 It's false. I agree there. Financial intermediaries are very important to the health of this of the whole financial structure, whole financial system. They play a pivotal role. I think we were discussing this last time, that they link the lenders and the borrowers, right? Ones that have got surplus and the others that have got a shortage, right? Money can be used interchangeably with wealth, but not income. True or false?
False.
Yeah, I think I also agree with false here. But I'm just gonna research again and see what the module requirement says on that one. But I think from what we've started so far and what we are gonna be starting, we'll realize that wealth consists of a number of other things that are not just money, right? There are some times where you don't have money in the bank, but you've got assets, you've got other assets, you've got bonds. So wealth has got to do with assets, of which money is only a part of the assets that a person can own. There are many other assets that you could own. So I think here I'll definitely go for false. Money cannot be referred to as money supply, as they have different definitions. True or false? Let me save you the time on this one. So when we talk of money in the context of this module, we are referring to money supply. So it's
Yeah.
one definition. So this one is true. Right. In a barter economy, transaction costs are relatively high because people need to satisfy a double coincidence of wants.
That's true.
True.
Perfect. So a double coincidence of wants is when we both want the same thing. For example, when we are supposed to be exchanging, but now we both want the same thing, so we can't exchange. So which means the transaction costs become very high now. Right. Money has the same primary functions in economy, whether it's shells, gold, or paper. Do we agree on that?
Yes, I agree.
Yes, I agree as well. Money is money, right? Whether sometimes money evolved, it was once shells, it became gold, silver, then it became paper. You know, it was really difficult back in the days, because I remember when I was reading about the situation where money, in terms of different empires, right, you find that let's just say a certain amount of money is gold. Okay, let's just say money is gold. Then there were instances now where they were mixing gold and silver, right? There are instances now where they were mixing gold and silver. So there was a problem. Now let's say we are different, like the different provinces that we have here in South Africa. You find that maybe in Mpumalanga, they've got, their money has got more silver than gold. And then you find that in KZN, that one has got more gold. You know, so it was really getting messy now. We don't know whose standard we need to go with, you see, as an alloy. So it all depended now on who was in charge in terms of the biggest empire of the time. So which means whatever they have, they go. So if the king decides that, okay, which means one coin must have a certain, this amount of gold, you know, then it's gonna be the same throughout the empire. So which means every other nation would have to adhere to that. But it was really difficult. It was not an easy thing, an easy system to go by. Fine, if it's gold, it's gold, but how much does one coin weigh? You see, I can't give you a big piece of gold still regarded as one coin. All right, then on 10, financial intermediaries allow small savers and borrowers to benefit from the existence of financial markets.
True.
True or false? True, right?
Yes.
You know, now you can easily trade on the stock market because of these financial intermediaries. These are even Mama Alan Gray, and then maybe some of the brokers that you guys could be in touch with. So they are basically giving you access to the financial markets. Then money can simply be defined as currency. True or false?
True.
Are we all agreeing on that one?
False. False.
False. Why false?
Isn't that money? There are three definitions of money.
Yes.
Am I saying the correct thing?
Yes, you are correct there.
Okay.
M1, but now there's that other M, it's what M1A. So there's M1A, M1, M2, and M3. So whenever you see money and definition, just think about those M's,
Okay.
M1, M2, of which currency is only on M1A. So there's a lot more other things too that are included here. But in terms of our everyday language, it's almost the same thing. Because when you talk of money in they call it colloquial, it's basically we're talking of currency. Right? But in terms of economics now, there are those other broader definitions, M1, M2, and M3. So in this instance, once you see money and definition, think of M1, M2, M3. Then once you see money and then functions, then you can now think of unit of account, exchange, those basic functions of money. Right. Then on the last one, since the financial intermediaries have evolved, they no longer reduce transaction costs. True or false?
Mm.
Do you think they no longer reduce transaction costs?
I'm gonna go for false.
You're gonna go for false. Why?
I'm guessing.
Okay. Right. I think this one has to be true because if you look at how they've evolved now, things have become better and better. If you look at in terms of trading, for instance, in the 80s, a lot of people were not trading. Trading was only done by the rich people, very rich people, right? But now, even if you got I'm sure if you got your gas, there's a trader there. You see, everyone knows a trader. I'm sure. Just go to your Instagram or to your Facebook, there you will get inboxes. People who are offering you. It's because the way these financial intermediaries have evolved now, everyone has got access. The reason why we didn't have so much access was because of high transaction costs. So high transaction costs were a very big they were a very big barrier, right? Particularly for people of color, right? Particularly for people of color. So you couldn't easily get access to those things, but now you can, right? So which means this will be true. So the way they've evolved, they are reducing these transaction costs. Sometimes if you think of transaction costs, I went out of the country not so long ago, right? And I really had difficulty transacting basically. It was very difficult to transact. I just didn't have access to my money in the account. Okay. Which is why that makes you think that, okay, so if I'm here within the country, I can easily do transactions because you can do e-wallets, you can swipe. Sometimes you don't even have to carry your card. You can just, use your phone. Sometimes, I mean, people got tired of putting cards in those machines. Then they say, now you can tap. You see, all that there is to reduce transaction costs. You see, they want you to spend or to engage in transactions, and it must be easy for you. So that's the whole point. All right, so we are jumping to today's notes. Right, we're jumping to today's notes. We are gonna be done. We are gonna be done shortly. All right, just give me a second. All right. I think this is it here. Understanding the interest rates. So I tried to make these notes very, 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 very simple. So for starters, in present value, we need to understand the concept of present value. Right? Because we are dealing with this is monetary economics. So we need to know that money is subject to a change in value, right? A perceived change in value. So which is why the future value and the present money is not going to be the same. Right? So we start off here with present value. So the concept of present value on present discounted value is based, right? Should be all Okay. The concept of present value or present discounted value is based on common sense notion that a rent paid to you 1 year from now is less valuable than a rent that is paid to you today. Right. Of course, it's a matter of there are a lot of factors that come into play there. But if someone owes you money, it's better they give you today, right, than they give you next year for many reasons. One of the reasons could be what if that person dies before they give you that money? Then it becomes a longer story now. You see. And besides, think of inflation, you see, and what have you. You can't exactly, buy the same things next year. So how do we calculate that? So present value is always going to be future value divided by 1 plus R. So R here is the interest rate that is used, and then to the power of n, to the power of number of years. Right? I'm sure maybe if you've done finance, accounting, any of those modules you've done, even financial maths, you've done quite a lot of these calculations there. Here we don't do much of those calculations. But it would be interesting for you maybe to know where this R comes from, who decides which R to use there. It's good because for our modules here, we are normally given the rate, but you should maybe wonder and research who comes up with that rate, what sort of things do you take into account. Right. And then a very important concept now also, because we are basically dealing with investments when we talk of interest rates, would be the yield to maturity, because the yield to maturity is very important for many reasons, right? For many reasons, which I think I listed down there. So I'm not gonna exhaust those. We'll get to them now. So this is basically a financial concept that is used to evaluate the total return an investor can expect to receive if they hold a fixed income security such as a bond until its maturity date. So we make quite a lot of reference to bonds here. Right? We make quite a lot of reference to bonds here, which are going to be representative of this type of asset that comes with its contractual cash flows, periodic cash flows. All right, so the YTM, which is the yield to maturity. So we already said we are looking at the total return that you expect to get. So should you hold it up until maturity? So it takes into account not only the interest payments, which are the periodic payments. These are referred to as coupon payments, right? So the coupon payments are the interest payments, right? Received over the life of the bond, but also any potential capital gains or capital losses. So for instance, if these bonds are traded in the open market, it means the value of those bonds is obviously going to be fluctuating, right? Based, of course, as we are going to see much later, on the interest rates, right? Which affects the demand supply of those bonds. So which means you could hold a bond today, and then by the time you get to maturity date, the value of the bond could have doubled or tripled. So when you look at yield to maturity, you take into consideration the value of that bond, right? Basically taking into advantage that the value of that bond could go up or could go down. So you take all that into consideration. So YTM therefore provides us an estimate of the annualized return an investor would earn if they held the bond until it matures. So it's just an assumption, or it gives us an estimate. Sorry, that's the right word to use there. But these are the following things that are taken into consideration now when you're dealing with the yield to maturity. So the coupon payments, which we said are the interest payments, the periodic payments. So if you get yourself a bond, a 10% bond, and it's worth 1,000 rand. So 10% of 1,000 is what? It's 100, right? So which means you're gonna be paid 100 per annum, 100 per annum. So we refer to that as coupon payments, right? I did a study the one time why these things are called coupons. Right? Why these things are called coupons? It's because every time a payment was made, you kind of like took a coupon out of it as an indication. So they then refer to these things as coupon payments. But they are basically just periodic payments, right? So they are usually, the bond's coupon rate is fixed interest rate stated on the bond, usually expressed as a percentage of the bond's value. So if it's a bond that is worth 1,000 rand, it's gonna be 10% of 1,000, which is what we are gonna be getting. What is the par value? Par value is the same as face value of a bond. So it's basically the nominal value, right? So it's the value which is typically the amount the issuer promises to repay the bondholder when the bond matures. So it's typically that amount. Sometimes it's not the amount, but it's normally going to be that amount. So the face value is what you get on your contract. So they tell you that your bond is worth 1,000 rand, for instance. That's the face value of the bond. So which sometimes may not be the same as what you will get at maturity, depending on the different arrangements or agreements that you have. Sometimes you have a bond that's worth, for instance, 1,000 rands. Then they tell you that at redemption, they're gonna basically give you back 900 rand, something like that, or 1,100. So you need to be flexible on that day. But basically, the face value is what you get there. The par value is what you get on your contract. Right. The market price. So the market price is the current price at which the bond is trading in the secondary market. So remember the one time we talked about the primary market and the secondary market. So initially this bond is gonna be issued at the primary market. Right. Normally it's gonna be issued at its face value, which is the nominal value, where we say we are issuing these 1,000 rands bonds. So this bond is worth 1,000 rands. So that happens in the primary market. It could happen that that bond, which the paper value is written 1,000, they decide that we are gonna issue it at 900. Sometimes they could issue it above that. Doesn't matter. That doesn't affect the face value though. Then at the secondary market, somebody else decides that they want to sell. They initially bought it at the primary market, but they want to resell it to someone else. Then all that occurs in the secondary market, right? And then it's obviously gonna sell at the current price, right? Which can either be higher or lower than the nominal value, right? Depends on the interest rates at that time. Then the time to maturity. So this refers to the remaining time until the bond reaches its maturity date, at which point the issuer repays the bondholder the face value of the bond. All right, and then reinvestment of coupons. YTM assumes that any coupon payments received are reinvested at the same YTM rate. So that's just an assumption there. All right, then why is YTM important? We use it as a comparison tool. But this one you can go through. It helps us in our investment decisions, whether to buy a bond or not, right? We are gonna decide there. We use the YTM, risk assessment, and then the valuation. That's important there, right? So we use the YTM basically now to evaluate these 4 types of credit market instruments. So the simple loan, the fixed payment loan, the coupon bond, and then the discounted bond. So the coupon bond, we're making a lot of examples on that day. So that's the coupon bond because of those coupon payments, the frequent payments. Right. So a simple loan is straightforward. If you wanna get the present value of a simple loan, this is how you get that. So here the YTM, right? I shouldn't have put it this way. If I say the YTM is calculated as follows, but you basically can use this formula. The YTM is I there, right? You basically make I, if you substitute the formula, it will give you your YTM. That is for a simple loan, but you're not going to be asked to do that calculation anyway. Right? And then a fixed payment loan. So this is called a fully amortized loan. So the lender provides the borrower with an amount of funds which must be repaid by making the same payment every period, such as per month, consisting part of the principal and the interest. I don't know if you guys have seen amortization tables, but this is where they come in. So when you're doing your house repayment, when you're doing your car installments, this is what you're doing. It's an amortized loan, because you are paying the interest and you are paying back the capital amount or the principal amount at the same time. So this is what is being referred to there, right? And then the coupons is what we're dealing with just now, right? And then a discounted bond is bought at a price that is below the face value, so it's a discounted bond. And then the face value is repaid at maturity. So a discounted bond does not make interest payments. So we sell you the bond at 900 rands, and then at redemption date we give you 1,000 rands. That's a discounted bond, right? And then now we distinguish between nominal and interest, real and nominal interest rates. So this is still the same as with first level economics. So nominal interest rates is the one that's quoted, right? It makes no allowance for inflation. And then the real interest rates, we have made an adjustment for inflation there. So if you are given the nominal interest rate, let's say it's 10%, and then the inflation rate is given as 3%. So the real interest rate is gonna be 10% minus 3%. That will basically give you the real interest rate there, which is gonna be 7. You find that by deducting, right? And then now we wanna draw a distinction between interest rates or interest and returns, right? Interest rates and returns. Right? Interest rates and returns are related concepts in finance, but they have distinct meanings and implications. Right? Interest rates refer to the cost of borrowing money or the return earned on investments, typically expressed as a percentage. That's an interest rate there. Right? So you will have 3 types. So one is the nominal interest rate, which we spoke about, and then the real interest rate, again, after adjusting the nominal interest rate for inflation. And then the effective interest rate. Now, this is the actual interest rate that is earned or paid after considering compounding, right? So it reflects the total return on an investment, including the impact of compounding over time. That's the effective interest rate. What about returns? So when we talk of returns now, we take into consideration capital losses and gains, income returns, so which are the regular payments that you get, and then the total returns. So where you're looking at both capital gains and then income returns. So that is what you get from that. So returns, think about yield to maturity. Think about yield to maturity. Yeah? That's what we get from that. And then the maturity and volatility of bond returns. When you talk of volatility, think of risk, right? So which is why here we talk of interest rate risk. So this refers to the risk level associated with an asset's return that results from interest rate changes. So how is your return affected after the interest rates have changed? You see, so that's interest rate risk. So if the central bank decides that the interest rate is going up or going down, how are your returns affected? So that's the volatility there, and that's interest rate risk. So prices and returns for long-term bonds are more volatile than those for short-term bonds. Bonds with a maturity term that is as short as the holding period have no interest rate risk. Right? Why is that the case? There is limited time for fluctuations, less exposure to future rates. So when we talk of fluctuations, we are looking at the interest rates fluctuations, right? So the longer you hold on to it, there's a likelihood that interest rates are gonna change. Okay. So again, lesser exposure to future rates, limited reinvestment risk, predictability. So if it's short, more predictable, and then a lower yield potential. Obviously, it's gonna give that there. All right, so you can as well go through the notes. Like you can as well go through the notes. I think I did try to make them as comprehensive as possible. And then next up, we are gonna be looking at what are we looking at? Let me just recheck there. I think I've got chapter number 6 is gonna be the risk and term structure of interest rates. That's what we are gonna be. No. We are going to chapter 5. Sorry. We are going to chapter 5. Yeah, we are going to be looking at the behavior of interest rates. Right, but I'm going to prepare the notes again and give them to you.